How much is my business worth? This is one of the most common questions that I get as an accountant and a business advisor. And in this video, I will try to give you the long version of this answer because there's a lot of moving parts. And I promise you, you watch the whole thing and you will like the proposal that I put together in order to determine the value of your business. So make sure you hit like if you're excited about hitting this topic. Here we go. My name is Hector Garcia, and I'm an accountant and a business consultant based out of Miami, Florida. I work with customers all over the world, and one of my jobs as a business advisor is to answer the difficult questions. How much is my business worth? It's just about one of the hardest questions to answer as an accounting professional. First of all, because CPAs actually have to have a special certification for doing formal business valuation. They also need to be independent, perform a financial audit, and do a whole bunch of things that are outside what most business advisors do in order to provide that proverbial number that the customers want. My clients, when they ask me that, what they expect from me is to say a number. Sometimes the facts and circumstances in which that business value will be used for can actually change the value of the business. For example, if you're evaluating the business for the purposes of maybe including it in a personal financial statement, that could be one number. If you're using the business as collateral for a bank, that could be a different number. If you're trying to sell a portion of your business to maybe a new partner, that could also be a different number. If you're trying to bring outside investors or do estate planning or maybe any other cases in which you would do that, the numbers would vary just based on the circumstances in which are being used to evaluate the business. But there's only one true answer. How much is my business worth? The only one that can answer this is a third party willing to buy it. And whatever that third party is willing to pay for it is the only number that you could ever use as the accurate number of, quote, how much is my business worth? But most of the time, people want to know that number before they actually make an offer, accept an offer, or put the business in the market, assuming that you're trying to sell the business in the free market. So accountants resort to simple valuation methods, which I like to call the balance sheet approach. And there's four of them pretty much. One of them is called the book value, where you pretty much take your balance sheet, read the total equity dollar amount, and that's pretty much the net worth of the business. On the free market value approach of the net assets, what you do is you reappraise all the values of the business at fair market value minus paying off all your debts, and then that would be the value of your business. There's also the liquidation value, which means let's say we were to shut the business down, go bankrupt, and do a fire sale and sell all the assets in an auction, in bankruptcy court, in foreclosure courts, that sort of thing. Sell all the assets there and only pay the liabilities that you're legally liable to pay. Whatever that dollar value is, that could be the liquidation value of the business. And then there's several cash flow models, which you take the actual historical net income of the company. You assume the company will continue to have that net income and grow over time. And there's a whole bunch of math and assumptions involved in that process. And that's one of the methods that business valuators use. Now, there are more complex or sophisticated methods, such as beyond balance sheet methods or market methods, such as appraising. You can go out and appraise the business by using comparatives of business that are similar, that were sold in the market in the near term, and use the proportion in terms of business size to assign it to your business. You can also do the market cap approach, and this is only available for companies that are publicly traded or that their stocks are being traded in some sort of market. So if someone is buying and selling the shares and the stock of your company, what somebody else is willing to pay for that stock is a good indication of what the value of the business is. And that's called the market cap approach, where you take the price of a stock or a share of your company times the total number of outstanding shares, and that would give you that value. But the problem is, in small businesses, we really don't have shares out there for people trading them. So the market cap method really only works for public companies. So then we resort, whenever we pay for a formal valuation, we will resort to an appraiser method where they would take some components of the balance sheet approach and the income approach and cash flow approach, and also compare it with what other companies are being sold that are similar, and try to come up with a number that kind of averages all the methods together. However, sometimes my clients want to just get a general idea of what the business is worth without having to resort to a third-party appraiser or have to actually list it in the market to get some offers to get an idea. And what we call that service is called an internal valuation and goodwill assessment. We also call that the going concern value, which basically we take the balance sheet models that we explained earlier, then we identify where the business stands in the 11 components of business value. That's my own concept. 11 components of business value is an internal concept that we use in our business for our advisory engagements. And this video is actually the very first time that I'm teaching this to the public. This actually was an internal know-how of our company. But anyway, those 11 components of business value that I'm going to list, what we do is we analyze each of them using a SWOT analysis, which is a pretty simple concept, which I'll explain briefly. And then we use that method to give us a good understanding of where the business is and where the business is going. And from there, extrapolate some sort of value to accompany the traditional methods of valuation. What is a SWOT analysis? Well, that's a strength, weakness, opportunity, threats comparison. So we take each of the 11 components of business value, which I'll discuss shortly, and we analyze the strengths, weaknesses, opportunities, and threats of each one. So we make a matrix for each one and lay it out on the table so we can analyze it as a whole when we're finished going through all 11 components. So the 11 components of business value are the following: retained earnings and growth expectations, that's 1. Income generating assets, that's 2. Infrastructure, that's 3. Your customer list, that's 4. Credit worthiness and supplier relationships, that's 5. Your brand, 6. Intellectual property, 7. Talent, 8. Location and distribution channels, 9. Intangible rights, 10. And finally, the 11th would be your social platform. So let's go through each of them. Your retained earnings are the total net profits from past years that were not distributed or paid out to the owners. In other words, the cash was kept in the business or reinvested back in the business. Then you have the income growth, which is the expectation that the company will continue to produce that income that they have been able to retain over years. Now, these are quantifiable value. These actually are numerical values. There are non-numerical values or qualitative values that we're going to cover on the next 10 components of business value. We got income generating assets. So if we have something like a piece of real estate that generates income not by doing a whole bunch to it or not by involving that many resources in the operation, that's called an income generating asset. So real estate's a good example, but tools and equipment that require employees and talent, that's different. We're going to cover that. There's also the concept of having recurring income from subscribers. We'll cover that in customer list, but they do cross this whole concept of income generating assets. Then we got infrastructure. These are typically tangible fixed assets, systems, technology that give the company a platform and a capacity to serve their customers and generate income. Amazon's website is a great example of that. Amazon's website is part of the infrastructure. The website by itself doesn't generate income like a piece of real estate would, but the website provides a platform in which Amazon can use to sell their own products or somebody else's products. Infrastructure can also be known as the tools that allow employees to serve their customers. And there are some concepts of intangible assets like patents and trademarks. We're going to discuss that later under intellectual property. Then we have the customer list. Now, this should be a list of satisfied customers. Obviously, unsatisfied customers are not really worth anything. If anything, they have negative value. But this is a list of customers that are likely to buy from you again. Now, a customer list that frequently buys from you or frequently goes to your business with the intention to buy, it's also part of this customer list. And also, if you have standard contracts, reasonably guarantee some sort of income or sales in the near future, barring some sort of catastrophe. That's also part of your customer list. Credit worthiness and supplier relationships. So the ability to borrow from banks, investors, private lenders because you've proven yourself to be able to pay them back. Any financial relationships you have with vendors, such as credit lines or credit terms, increase your cash flow and they're huge components of business value. Now, just the sheer ability to be able to buy from vendors or have access to better prices due to the relationship you have with them is a huge component of business value. And in most cases, the years you've been in business can be extrapolated more or less with credit worthiness. Because the longer you're in business, the lower the probabilities that the business will fail. Then we have the big one, your brand, probably the biggest one of the intangible values. The recognition and awareness you get from customers and potential customers about what your company does. I think of brand as the first thing that pops into a customer or a potential customer's head when they think of your business while they're not doing business with you. What your company stands for or against is really, really important. That's kind of your positioning. Then the unique value proposition, which is what you do that's not just different but unique, that your customers know that you're the only one that can provide, is extremely important and valuable. Your reputation, and we'll talk about social media towards the end, but your reputation is extremely important. If you're known to serve a target market or a narrow niche market, that's also a big component of your brand. The perceived quality of your products and services are also part of the brand as well. And your marketing platform, like if you have a marketing system that people know and recognize, that's also part of the brand. It's both who you market to and how you market to them. Now we have intellectual property. This is your knowledge base of internal procedures and processes that is particular to your business and makes your product and service unique. You have trademarks and patents, which are pretty much protected by government. And finally, the know-how, that special sauce that makes your business do things differently than everyone else. Now we have the talent. The talent is the capabilities of employees currently have that a brand new employee wouldn't necessarily be able to have in the short term of being hired. The ability for your current employees to apply the know-how while protecting the intellectual property is a huge piece of talent. The overall corporate culture that permeates positively to your customer service and the quality of your products and services are an extremely important component of value when it comes to talent. And you're going to have your current leadership, your bench for your future leadership, and overall employee retention. It's one of the most important and costly things to build, so it's a huge component of business value. Your location and distribution channels. So if you're a retail store or a restaurant, your physical location is really, really important because that's where people are programmed to go to buy from you. But if you sell digital services or products over the web, your web presence, your search rankings, your website traffic plays a big role in this concept of location in a digital world. And your distribution channels are extremely important, such as being able to sell to big retailers like Walmart or Target. That's a really important piece and increases the value of your business. Now, the intangible rights are kind of an interesting concept. These are special licensing permits, contracts, geographic protection, in some cases, trademarks that create a unique barrier of entry for new competitors. If you have non-compete agreements with people that know what you know and how you do it, and they're enforceable, they can be of value. And just simply becoming a vendor for a big, unique customer, like having the certification or you went through the process of becoming a vendor for them, it's a really important sort of intangible right. And finally, we have the social platform. Now, in today's world, this is probably one of the most important things. This is the communication platform that you have, your capacity to have two-way communication with customers and potential customers, also known as the followers. That's what they call it in the social media world, because they can create a real positive word of mouth network effect to promote your business, especially for new products and services. And your ratings and your reviews in social networks are becoming more and more important, regardless of whether you sell a product or a service, because folks are looking at their peers for their experiences with your company before they buy from you. So at the end of the day, we take a SWOT analysis where we analyze all 11 of them. We understand where our business stands strategically in each of them, and we try to extrapolate the value from there. That is going to be the best way to get a really good idea of what someone is willing to pay for your business, because in those 11 components, maybe in just one of them or all of them, exactly what makes or drives someone to want to buy your business. Now, if you need a business advisor, there's my phone number and my email. You can reach me. You can show this presentation to your current accountant and see if they like it, or maybe they can help you figure out the value of your business. And if you like this video, make sure you give it a big thumbs up and check out another video that's very similar contents that I consider to be sort of the part 2 to this video, or this one could be the part 2 to that video. I'll put it in the description below so you can check it out. It's called the 17 worst questions you can ask your accountant or business advisor. Thank you.